Oil markets are once again capturing the attention of investors, governments, businesses, and consumers around the world as crude oil prices continue to climb sharply following a new wave of geopolitical tensions in the Middle East. According to Reuters, Brent Crude and U.S. West Texas Intermediate crude both moved significantly higher after reports of increased military activity involving the United States and Iran, raising fresh concerns about the security of global energy supplies. These developments have immediately pushed traders to reassess the risks facing one of the world's most important oil-producing regions, with many market participants closely monitoring every new development for signs of either further escalation or possible de-escalation. While the physical supply of oil has not yet experienced a major interruption, the uncertainty surrounding future shipments has become enough to drive prices to their highest levels in several weeks, reminding global markets once again of how sensitive energy prices remain to geopolitical events. Reuters reports that Brent crude futures rose close to 3%, trading near $85 per barrel, while U.S. West Texas Intermediate crude climbed close to $80 per barrel during early trading. These gains followed an even larger rally in the previous trading session when Brent crude recorded its strongest daily increase since May 2020. Such dramatic movements highlight how quickly oil markets can react whenever investors fear that supplies from the Middle East could become disrupted. Financial markets often respond not only to actual supply shortages, but also to the possibility that future production or transportation could be affected. In many cases, expectations alone are enough to move prices significantly before any measurable reduction in exports actually occurs. At the center of these concerns is the Strait of Hormuz, one of the most strategically important waterways in the global energy system. This narrow passage connects the Persian Gulf with international shipping routes and serves as the primary export route for crude oil produced by several major Middle Eastern countries. Every day, millions of barrels of crude oil and petroleum products travel through this narrow waterway on their way to markets across Asia, Europe, and other regions. Because such a large percentage of global oil exports depends on the uninterrupted flow of tankers through this area, any military tensions or security threats immediately attract worldwide attention from governments, traders, shipping companies, and energy producers alike. According to Reuters, market participants have become increasingly concerned after reports of renewed military actions and heightened tensions between the United States and Iran. These developments have introduced a new layer of uncertainty regarding the safety of shipping routes through the Strait of Hormuz. Although the waterway has not been fully closed, analysts say that the increasing risks have forced traders to price in what is commonly known as a geopolitical risk premium. This additional premium reflects the possibility that future supply disruptions could occur if the security situation deteriorates further. Financial markets are built on expectations. Oil traders do not simply wait until exports stop before reacting. Instead, they continuously evaluate the probability of future events. If they believe there is a growing chance that oil supplies could become constrained, they often begin purchasing contracts immediately, pushing prices higher well before any actual shortages develop. This forward-looking behavior explains why oil prices frequently experience large swings during periods of international tension, even when production facilities continue operating. Normally, Reuters also reported that shipping activity through the Strait of Hormuz has declined compared with previous days. While oil exports continue, the reduction in tanker movements has added to market concerns that transportation risks may be increasing. Shipping companies must constantly evaluate the safety of their vessels, crews, and cargoes. Higher insurance costs, increased security measures, and possible delays all contribute to rising transportation expenses, which can eventually be reflected in higher energy prices for consumers around the world. Analysts quoted by Reuters emphasize that the physical movement of crude oil remains the most important factor to watch. If tankers continue moving through the strait without major interruption, some of the recent price increases could eventually ease as market fears decline. However, if vessel traffic experiences meaningful disruptions or export flows begin slowing significantly, oil prices could climb even further as traders factor in a greater risk of reduced global supplies. This uncertainty explains why investors across financial markets remain cautious. Oil is not simply another commodity. It plays a central role in the global economy by powering transportation systems, supporting manufacturing industries, generating electricity in many countries, and serving as an essential input for countless products. Any significant increase in oil prices can quickly spread through the broader economy, influencing inflation, transportation costs, airline ticket prices, shipping expenses, food production, and consumer spending. Higher oil prices also create important consequences for central banks around the world. Many monetary authorities have spent the past several years attempting to bring inflation under control through higher interest rates and tighter monetary policy. If energy prices rise substantially for an extended period, inflation could begin increasing once again, making it more difficult for central banks to reduce borrowing costs. Investors therefore pay close attention not only to military developments, but also to the potential impact those developments could have on future inflation and interest rate decisions. Countries that rely heavily on imported oil face particular challenges during periods of rising crude prices. Higher import bills place additional pressure on government budgets, increase trade deficits, and often weaken local currencies. Businesses that depend on transportation or energy-intensive production may experience higher operating costs, forcing them to either absorb those expenses or pass them along to consumers through higher prices. In both cases, economic growth can slow as purchasing power declines and businesses face greater uncertainty. Oil exporting countries, on the other hand, may experience temporary financial benefits when crude prices increase. Higher export revenues can strengthen government finances and improve fiscal balances. However, these advantages can quickly disappear if geopolitical instability disrupts production or shipping activities. Stable exports remain essential for producers to fully benefit from higher prices. Reuters also cited market analysts who stressed that uncertainty itself has become one of the strongest drivers of current price movements. Investors are watching each new report carefully, understanding that headlines related to military activity, shipping conditions, or diplomatic developments could rapidly change market sentiment. Even relatively small developments can trigger significant price volatility, because traders recognize how important the region is to global energy supplies. Another factor influencing the market involves expectations surrounding future inventory levels. Reuters reported that preliminary forecasts suggest U.S. crude oil stockpiles may have declined during the previous week, while gasoline and distillate inventories could have increased. Inventory reports are closely monitored because they provide valuable information about the balance between supply and demand. Falling crude inventories often suggest stronger demand or reduced production, both of which can support higher prices. At the same time, rising gasoline inventories may indicate changing consumption patterns or seasonal adjustments that investors also consider when evaluating future market conditions. Energy traders rarely rely on a single indicator when making investment decisions. Instead, they analyze geopolitical developments, shipping activity, production levels, refinery operations, inventory data, economic growth forecasts, currency movements, and weather conditions simultaneously. Each factor contributes to the broader picture that ultimately determines oil prices. During periods of heightened geopolitical tension, however, security concerns often become the dominant influence because unexpected disruptions can rapidly reshape global supply expectations. For countries like Iraq, developments in global oil markets carry particular significance. Iraq remains one of the world's major oil exporters, and fluctuations in crude prices directly affect government revenues, fiscal planning, infrastructure investment, and broader economic performance. Stronger oil prices can increase export income, potentially providing additional financial resources for public spending and development projects. However, policymakers must also remain aware that prolonged regional instability can create challenges for investment, trade, and economic confidence, even if oil revenues initially rise.
As investors continued evaluating the latest developments, attention remained firmly fixed on the balance between actual oil supply and perceived future risks. Financial markets often react long before any measurable disruption occurs because commodity traders understand that once a physical shortage develops, prices can rise dramatically within a very short period of time. That is why every update concerning tanker movements, shipping routes, diplomatic negotiations, or military activity becomes extremely important. Reuters reported that analysts are carefully monitoring whether crude continues flowing normally through the Strait of Hormuz, as this remains the single most important indicator for determining whether the recent price rally has further room to continue or whether markets may eventually stabilize. One of the defining characteristics of today's oil market is that expectations can influence prices almost as much as actual supply. Investors are constantly trying to anticipate future conditions, rather than simply reacting to present circumstances. If traders believe that oil exports may face restrictions in the coming days or weeks, many will begin purchasing crude contracts immediately. This increased buying activity naturally pushes prices higher, even if production facilities remain fully operational and tankers continue transporting oil without interruption. In this way, the oil market reflects not only physical barrels of crude but also confidence, uncertainty, and expectations about what could happen next. Market analysts interviewed by Reuters explained that the current rally contains what is commonly described as a geopolitical premium. This premium represents the additional value traders assign to oil because of heightened political and security risks. During periods of stability, this premium tends to shrink as investors become more confident that supply chains will remain uninterrupted. During periods of conflict or uncertainty, however, the premium grows because the market recognizes that unexpected events could quickly tighten global supplies. As a result, oil prices often rise well before any actual reduction in exports is confirmed. Another important aspect influencing market sentiment is shipping confidence. International shipping companies operate some of the world's largest fleets of oil tankers, transporting millions of barrels every day across international waters. Whenever security risks increase, shipping companies must reassess routes, insurance coverage, crew safety, and voyage schedules. Even if vessels continue sailing, increased insurance costs and longer security procedures can raise transportation expenses. These higher costs eventually become part of the overall price consumers pay for refined petroleum products such as gasoline, diesel, and jet fuel. The insurance industry also plays a major role during periods of geopolitical uncertainty. Marine insurers closely evaluate the level of risk associated with transporting valuable cargo through sensitive regions. If the perceived danger increases, insurance premiums for vessels may rise significantly. These additional costs are ultimately absorbed somewhere within the supply chain, either by exporters, refiners, distributors, or end consumers. Consequently, geopolitical tensions can influence fuel prices even without reducing the total volume of oil reaching international markets. Energy. Companies themselves must also make strategic decisions during uncertain periods. Large producers continuously evaluate whether production targets should remain unchanged or whether operational adjustments may become necessary. At the same time, refinery operators monitor crude availability to ensure they maintain sufficient inventories for fuel production. Every decision made throughout the energy supply chain contributes to the broader market environment that determines daily oil prices. Beyond the immediate energy sector, rising crude prices can influence virtually every major industry. Airlines typically experience higher fuel expenses, increasing operational costs that may eventually affect ticket prices. Shipping companies face similar challenges as bunker fuel becomes more expensive. Manufacturing businesses that depend heavily on petroleum-based materials may encounter increased production costs, while agricultural producers often pay more for transportation and fertilizer. These higher expenses can gradually spread throughout the economy, affecting prices paid by households around the world. Consumers generally notice rising oil prices first at the fuel pump. As crude becomes more expensive, gasoline and diesel prices often follow, although the timing varies depending on local taxes, refinery operations, and inventory levels. Higher fuel prices reduce disposable income because households spend more of their budgets on transportation. This leaves less money available for discretionary purchases, which can slow economic activity in other sectors such as retail, hospitality, and entertainment. Governments also monitor oil prices closely because sustained increases can influence national inflation rates. Energy represents an important component of consumer price indexes in many countries. When fuel costs rise, transportation becomes more expensive, increasing the cost of delivering food, manufactured goods, and essential products. Businesses facing higher transportation expenses frequently pass part of these costs on to consumers. As inflation accelerates, central banks may find it more difficult to lower interest rates or stimulate economic growth. Currency markets likewise respond to developments in energy prices. Countries that export large quantities of crude oil often benefit from stronger export revenues when prices rise, potentially supporting their national currencies. In contrast, countries heavily dependent on imported energy may experience increased demand for foreign currency to pay for oil imports, placing downward pressure on their exchange rates. Investors therefore analyze oil prices not only as an energy indicator, but also as an important influence on global foreign exchange markets. For Iraq, fluctuations in international crude prices remain particularly significant because oil exports contribute substantially to government revenue. Higher global oil prices can improve fiscal income, strengthen public finances, and provide additional resources for infrastructure projects, social programs, and economic development initiatives. However, policymakers also recognize that excessive price volatility creates planning challenges. Stable markets generally allow governments to prepare budgets more effectively than periods of rapid price swings driven by geopolitical uncertainty. Investors in stock markets also pay close attention to oil movements because different industries react in different ways. Energy companies may benefit from higher crude prices through increased revenues and stronger profit margins. Conversely, transportation companies, airlines, logistics firms, and certain manufacturing businesses often face increased operating costs. As a result, rising oil prices frequently produce mixed performance across equity markets, with some sectors advancing while others experience selling pressure. Another important factor is market psychology. During uncertain periods, investors sometimes move capital toward assets they perceive as safer, while reducing exposure to sectors viewed as vulnerable to geopolitical risks. Oil itself can become both a source of opportunity and concern depending on each investor's strategy. Some market participants expect continued price increases and position themselves accordingly, while others anticipate eventual diplomatic progress that could reduce tensions and bring prices lower. Reuters also highlighted expectations regarding U.S. inventory data, which market participants examine carefully each week. Inventory reports provide valuable insight into whether domestic supply is tightening or expanding. A larger-than-expected decline in crude stockpiles may suggest stronger demand or reduced production, both of which can support higher prices. On the other hand, larger inventory builds sometimes indicate weaker demand or improved supply conditions, potentially easing upward pressure on crude prices. Because these reports are released regularly, they often trigger significant short-term market volatility. In addition to inventory figures, investors monitor production levels from major oil-producing countries, refinery utilization rates, seasonal driving demand, aviation fuel consumption, and broader economic indicators. Strong global economic growth generally increases demand for energy because businesses manufacture more goods, transportation activity expands, and consumers travel more frequently. Conversely, slower economic growth can reduce oil consumption, placing downward pressure on prices, even if geopolitical risks remain elevated. Despite the recent rally, many analysts caution against assuming that prices will continue climbing indefinitely. Reuters noted that much depends on whether physical oil flows remain uninterrupted. If exports continue moving through the Strait of Hormuz without significant delays or reductions, some of the current geopolitical premium could gradually diminish. Markets often experience sharp rallies during periods of uncertainty, followed by partial corrections once traders conclude that worst-case scenarios have not materialized. This pattern has occurred repeatedly throughout the history of global energy markets. At the same time, traders remain aware that geopolitical developments can evolve rapidly. A single diplomatic breakthrough could improve market confidence almost immediately, while additional security incidents could produce another wave of buying.
As the global energy market enters another period of heightened uncertainty, governments, financial institutions, multinational corporations, and investors are preparing for a range of possible outcomes. One of the biggest lessons from previous geopolitical crises is that energy markets rarely remain calm when uncertainty surrounds one of the world's most important oil-producing regions. Even if production continues normally, the possibility of future disruptions can keep prices elevated because traders prefer to prepare for risk rather than react after supplies have already been affected. According to Reuters, analysts continue to emphasize that the physical movement of crude through the Strait of Hormuz will remain the most important factor determining whether the recent rally continues or begins to reverse. For now, global markets are balancing two competing realities. On one hand, concerns over regional tensions have significantly increased the perceived risk surrounding energy supplies, leading investors to push crude prices to their highest levels in several weeks. On the other hand, oil continues to flow through international markets, and no widespread interruption to global supply has yet been confirmed. This contrast explains why markets remain extremely sensitive to every new development. Traders are not only responding to what has already happened, but also attempting to anticipate what could happen next. History has shown that geopolitical events often create sharp but temporary movements in commodity prices. During previous periods of conflict, oil markets experienced sudden spikes followed by gradual declines once investors became more confident that exports would continue without major interruption. While every situation is different, experienced market participants understand that emotions can temporarily push prices beyond levels supported by actual supply and demand. As additional information becomes available, prices often adjust to reflect a more complete understanding of market conditions. That is why analysts continue encouraging investors to distinguish between immediate headlines and longer-term fundamentals. Headlines can trigger rapid price movements within minutes, but sustained trends usually depend on broader economic conditions, production levels, global demand, inventory balances, and the ability of energy producers to maintain reliable exports. If these fundamental factors remain relatively stable, markets may eventually regain some of their balance even after periods of heightened volatility. At the same time, the energy industry has become considerably more resilient than it was decades ago. Many producing countries maintain strategic reserves, diversified export routes, and contingency plans designed to reduce the impact of temporary disruptions. Importing nations also maintain strategic petroleum reserves that can be used during emergencies to stabilize domestic supplies if necessary. These measures cannot eliminate geopolitical risks, but they provide governments with additional tools for responding to unexpected events. Another important factor influencing the outlook is the role of international diplomacy. Diplomatic discussions often continue even during periods of military tension, with governments working through multiple channels to reduce the risk of broader regional instability. Investors therefore monitor not only military developments but also official statements from governments, international organizations, and diplomatic representatives. Any indication of renewed dialogue or efforts to reduce tensions can quickly improve market confidence and influence commodity prices. For businesses operating within energy-intensive industries, managing uncertainty has become a central part of strategic planning. Airlines, shipping companies, logistics firms, manufacturing businesses, and chemical producers often use financial instruments to hedge against future fuel price increases. These hedging strategies allow companies to lock in energy costs for future periods, reducing exposure to sudden market volatility. Although hedging cannot eliminate all risks, it helps businesses plan more effectively during uncertain market conditions. Consumers also play an indirect role in shaping energy demand. Seasonal travel patterns, industrial production, and economic growth all influence how much crude oil the world consumes each day. During periods of strong economic expansion, demand for transportation fuels typically increases, supporting higher oil prices. Conversely, slower economic activity can reduce fuel consumption, offsetting some of the upward pressure created by geopolitical concerns. As a result, investors continue monitoring economic indicators from major economies alongside developments in the Middle East. Financial markets beyond the energy sector are also watching closely. Equity investors evaluate whether higher fuel costs could reduce corporate profits, while bond markets assess the possible impact of rising energy prices on inflation and monetary policy. Currency traders analyze how changing oil prices may influence trade balances and capital flows, particularly for major oil exporting and oil importing countries. This broad market attention demonstrates that crude oil remains one of the most influential commodities in the global financial system. For Iraq and other major oil exporting nations, developments in international crude markets remain especially significant. Higher oil prices can strengthen government revenues and improve fiscal flexibility, providing additional resources for investment in infrastructure, healthcare, education, and economic development. However, long-term prosperity depends not only on favorable oil prices, but also on stable production, reliable export routes, sound fiscal management, and continued investment in the energy sector. Temporary price increases can provide financial benefits, but governments generally prefer stable markets over periods of extreme volatility because stability supports better long-term planning. Energy analysts also caution that markets should avoid reacting solely to speculation. Reuters noted that while geopolitical risks have clearly increased, the future direction of oil prices will depend heavily on real-world developments affecting supply and transportation. If crude continues moving efficiently through established export routes, some of the current risk premium could gradually decline. If significant disruptions emerge, however, markets may respond with additional price increases as traders attempt to account for reduced global supply. One of the most closely watched indicators in the coming days will be shipping activity through the Strait of Hormuz. Every tanker that successfully completes its voyage provides reassurance that global supply chains remain operational. Conversely, any meaningful decline in vessel movements or export volumes would likely attract immediate attention from energy traders and policymakers worldwide. Because such a substantial share of internationally traded crude passes through this narrow waterway, even relatively small operational changes can influence market expectations. Another important source of information will be official inventory reports from the United States. Market participants routinely compare actual inventory figures with analysts' expectations to gauge whether crude supplies are tightening or expanding. If inventories decline more than expected while geopolitical tensions remain elevated, traders may interpret that combination as supportive for higher prices. Conversely, stronger than expected inventories could provide evidence that supply conditions remain comfortable despite current uncertainties. Investors will also continue monitoring statements from major oil producers regarding production targets and export capacity. Decisions made by leading producers can significantly influence market sentiment, particularly if they signal either increased production to stabilize supplies or caution regarding future output. At the same time, global demand forecasts issued by international energy organizations will help determine whether consumption growth remains strong enough to support current price levels over the longer term. Ultimately, the oil market remains a reflection of both economics and geopolitics. Supply, demand, production costs, inventories, transportation networks, and consumer behavior all contribute to price formation, but geopolitical developments can temporarily become the dominant force when uncertainty increases. Reuters reported that the recent rally illustrates exactly how quickly markets can respond when investors perceive increased risks surrounding one of the world's most important energy corridors. As the situation continues to evolve, traders, governments, businesses, and consumers will remain focused on verified information rather than speculation. The coming days are likely to bring additional updates that could influence market expectations in either direction. Whether prices continue climbing or begin to stabilize will depend largely on the security of global energy transportation, the availability of crude supplies, and any diplomatic efforts aimed at reducing regional tensions. For now, oil markets remain on high alert. Every new report concerning shipping activity, inventory data, government policy, and international diplomacy has the potential to shape investor sentiment. While uncertainty has undoubtedly pushed prices higher in the short term, the longer-term outlook will be determined by the resilience of global energy supply chains and the ability of market participants to adapt to rapidly changing conditions. Until greater clarity emerges, volatility is likely to remain an important feature of global energy markets, reminding investors once again that crude oil continues to sit at the center of the world's economic and geopolitical landscape. That concludes today's market update. If you found this analysis helpful, make sure to subscribe to the channel, turn on notifications, and join us for the latest updates on global oil markets, the Iraqi economy, the Iraqi Dinar, international finance, and major geopolitical developments that continue to shape the global financial landscape. Thank you for watching, and we'll see you in the next update.